Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers. And first of all, good morning and happy Friday. And thank you for joining me today. Now, mortgage rates in the 10-year right now is absolutely skyrocketing once again and exploding. So there is a lot of movement right now when it comes to interest rates. We'll go over that now. Today's special value is going to be, before I really get into the housing market update, I'm going to show you guys basically how a loan officer calculates qualifying income. It's probably only going to be about 5 minutes, but I'm going to pull up a paycheck stub. I'm going to pull up a Schedule C, which is basically what self-employed people file for their taxes. And I'm going to show you how loan officers look at that. So I really hope you guys like the special hidden value. I try to inject value in every single one of my videos. But real quick, you guys, before I say good morning and before I really begin, I need your help. And it's not just liking this video, but if you can't like the video, I need your help. I have a friend. In Austin. All right. She has to sell her house. If there's any realtors that are watching right now and you're in Austin, please email me if you're willing to list her house for 1% commission. Not 3, but 1. I need your help, guys. So again, if you're a realtor in Austin, I have a friend. They need help. I would be happy to, get your help, but only 1% commission. She's upside down in her house. Unfortunately, she's recently purchased. She has to move, and now she's upside down. So I'm trying to help her find a good realtor that won't charge her like a crazy amount of money. So if you guys, know anyone that will do that, email me. My email is in the description, but let's get on with this video. That's really important to me, though. I'm really serious. If you are a realtor in Austin, please reach out to me. But first of all, I want to say good morning to Florida Beach Bum. I wish I was just like you, a bum on the beach. Earl, good morning. Number 2, Mary, good morning. Appreciate you guys. AJ's in the house. Jacob's in the house. Definitely appreciate you guys. My man, Medic from the beginning, just sold his house. Going out to Boise. Good luck in Boise, my friend. Dean, good morning to you as well. Manuel, Sheldon from the beginning. Sean and Wendy. Always like seeing you. Steve-O, first in the West. Always, brother. Appreciate you. Don't move. Appreciate you as well. There you are, Sheldon. Tony. All right, guys. I'm going to get going. Sacred's in the house. Christy as well. Vovo. Oh my, Elijah, there you are. Oh my gosh. Teddy, Joe, Teddy, where you been, Teddy? Teddy, where you been? I need you, Teddy. You lift me up. Where you at, Teddy? Love you, brother. There's my man, Tony, Johnny. You guys, I may do a live cast. I'm trying to convince Johnny. I didn't even hear what he's looking at. Oh yeah, historically low. Okay, but I maybe do a live cast with Johnny this weekend. Let me know if you guys want to do that. But I'm gonna get started, you guys. Before, oh my gosh, I gotta say hi to Jeff. Oh, and Anonymous is here. My gosh, and Vital's here. I love you guys so much. Since I have all and WTH. What are you guys doing? Why aren't you working? I love you guys. Happy Friday. You guys better not be going out tonight, drinking, spending your money. You guys be safe, save your money, have a meeting with your spouse, and re-budget your goals. Now, let's get into the interest rate part of all of this right now. I'm going to show you guys basically where rates are at right now. And I'm going to show you guys kind of a dirty little secret when it comes to mortgages, essentially showing you guys the more down payments you have, the higher your interest rate, going up to about 20%. All right. So I want, so in other words, be careful what you're assuming. Now, here's Google. I'm not going to Mortgage News Daily today. I'm just putting in mortgage rates with Google and look at what the mortgage rates are at a 640 to 659 credit score. Basically 8%. All right. So here's what I want to show you guys. Okay. And listen to me very carefully. The more money you put down, the higher your interest rate. And it should not be like that. The more money you put down, your interest rate should be lower because there is less risk for the bank. So why are lenders giving you a higher interest rate for the more money you put down? The reason is because they don't want you paying off your mortgage. They want to make as much money off your interest as possible. Now that does change at about 20% down, but I wanted to show you. So right now, we're sitting at an 8.02%. This is at 3% down. So that's probably a Home Possible or Home Ready loan for first-time home buyers. Really good loan. But watch what happens when I increase my down payment to 5%. It goes to 8.1. So the more money I just put down, the interest rate went up. And let me show you guys again. Let's go to 10%. So it goes from 8.1 to 8.13. So again, more money down. Let's go to 15%. Look at that huge hit at 15%. So in other words, if you put 15% down, you're probably going to have a much higher rate by what, 35 basis points? Isn't that insane to you? Now at 20% down, you guys, it starts going down. You can see that, but it's still higher than what it was at 3%. Isn't that insane? Now, when you put 25% down, it gets better. Okay. So 25% down is when you start getting a break. So I just wanted you guys to know that it's pretty crazy that lenders do that to you. But just FYI on that. Now, let me show you guys real quick the income. All right. And again, we'll get into the market update. The 10-year is going crazy right now. But you guys know how I'm always like, increase your purchasing power, credit, income, assets. So we went over credit. And I'll go in a little bit more credit. We also went over value, like how is value calculated with appraisals. So now I want to go over the income part of this. Now, I want to talk to you guys about this information as if I was as a loan officer, right? So as a loan officer, I want to qualify for, someone for a loan, say they have great credit, say they have their money saved. Really, the hard part about being a loan officer is income calculations. Again, income calculations. And that's a huge difference between right now and 2008. In 2008, you didn't need a down payment and you didn't need to make money, essentially. Fast forward to today, it's different. Okay. That's all I'm saying. It's different. But here's what I want to show you. Okay. This is an example paycheck stub. Now, it's really easy. And again, I'm talking about qualifying income. Why is it important to understand qualifying income? Because if you need to get a loan, your qualifying income is your purchasing power. Right? The more that you make, the more you will qualify for. So I needed you guys to understand what about your income can you use and what can you not use. So here's a paycheck stub right here. And now, firstly, I want to tell you guys, as a loan officer, the easiest thing to calculate as far as qualifying income is hourly. So right now you can see that this paycheck, the rate is $10 an hour. They work 40 hours a week, which is considered full time. So to calculate their income is so easy. The easiest income to calculate, I would take 40 hours, $10 an hour, and I would generate their yearly income divided by 12. All right. So the hourly and the salary, super easy. Easiest thing in the world. But where it gets difficult is everything else, starting with overtime. You guys can see overtime right here. You can see bonus right here. You probably remember me saying that work your overtime, bonus, and commission because you need what? 2 years to use that as qualifying for a loan, qualifying income for a loan. So I wanted you guys to pay attention. So as a loan officer, when I see overtime and I see bonus on a paycheck stub, what I have to do to use it is first I have to order a verification of employment to make sure you've been getting it for 2 years. Then I have to total the cumulative amount over 2 years and divide by 24 months. So 2 years of bonus divided by 24 months equals our monthly. Same thing with commission, same thing with bonus. So y'all see what I'm saying? So even though this person got $1,600, $1,000 here for a bonus, $200 for overtime, I take the year to date plus however much more I need to make 2 years. Do y'all see what I'm saying? And now in order to build that gap, remember, you need a 2-year history. What if they lose their job? What if this person loses their job, they go to work for another company, and they get overtime and bonus? This is where it gets tricky in lending. The way it's okay if you go to a different job and you're making bonus and overtime, so long as it's a similar amount. You don't want to have a decrease in overtime, bonus, or commission of 20%. So long as your new job has these additional payment types, you're okay. All right. Again, the way that you build that bridge is something called a verification of employment, whereas the mortgage holder or the mortgage, whoever you go through to get a loan, basically writes in to your previous employer, and your previous employer gives them a breakdown. All right. So anyways, just real quick, wanted to show you guys that. Now let me show you the self-employment real quick. I know this is boring. We'll get through this quickly. Now, here's what's called a Schedule C. Again, this is an example. I got this off the IRS website, so none of this is accurate. But regardless, this is a profit and loss for a business for sole proprietorship. So if you're not a corporation, this is probably what you're filing if you're self-employed. Remember, you need 2 years. So I need 2 years of that as a loan officer to use this as income. Now, if you're incorporated, you're probably going to file an 1120 or an 1120S, and it's going to look very similar to this. But I wanted to show you guys how this works for self-employment. You guys can see on the Schedule C, you start with gross income. Okay, so on self-employment, you start with that gross income of $45,000. You can see that right here. But unlike W-2 people, we have to take out a whole bunch of stuff of the income. Again, if you're W-2, you don't. If you're W-2, some reason you're able to use your gross income, which is completely ridiculous to me. But again, W-2 gross income. If you're self-employed, they destroy you. Do you hear me? They destroy your income if you're self-employed. So let me show you how this works. So look, we start at 45,000, but that's not our qualifying income. We have to get the net, which is way lower at $26,000. So the way that this person filed their taxes, they lost $19,000 roughly, $19,000 of qualifying income. So when you're self-employed, you want to be careful as far as all of the deductions that you're making. Now, that's an advantage of being self-employed. Don't get me wrong. I'm self-employed. I have like 3-4 companies. I love tax deductions. I'm just saying there's a balance, right? Because the more you tax deduct, the more you reduce your purchasing power. Now, let me show you what you can actually add back in. So there are certain things that I can add back into that net 26,000. One of those things is mileage, which will be in section 9. Now, generally I'm able to add, I think it's 24 cents a mile. Okay. And there'll be a separate breakdown for mileage on a tax return. Now, another thing, which is really, really one of the best things about self-employment is depreciation. I cannot tell you how important it is personally. Again, talk to your CPA, but depreciation, huge. That's why a lot of these people that are self-employed, they buy a truck or they buy a car and they do, $30,000 in depreciation right here. You guys, you get to add back 100% of the depreciation. So if I put a $20,000 depreciation expense in line 13, I get to add that back, this line right here, I get to add that back in to this income. Again, we're talking about qualifying income. Now, also I get to add back in the, let's see here, home office expense. So guess what? You see this? This is a home office. Guess what I do on my tax return? I have a home office expense. My home office expense allows me to deduct certain things like rent and things like that. But you can actually add back in your home office expense. Now, the bad thing is you have to minus out, again, any meals and entertainment. So you want to be careful on meals and entertainment, which is 24A. But if you can, again, you do never lie on your taxes. Never commit fraud, ever. It's stupid. Excuse my language, right? But anyways, you want to at least be aware of what you can use to qualify for a loan. So again, you can add back in mileage and depreciation and home office, but you have to retake out meals and entertainment, which would be 24A and 24B. So I hope that made sense. Did you guys, I hope you guys like that. Watch this again some other time if you want. I'm going to get into the update part of the video real quick. I can't believe I've been talking for 12 minutes already. Jeez, you guys must be sick and tired of listening to me. All right, guys, let me show you this real quick, and we're going to go into the interest rates. One more time on the amortization schedule. I'm putting in a $350,000 loan. I'm amortizing it over 30 years at a 7.5% interest rate. I'm calculating the amortization schedule. I see that on a $350,000 loan at 7.5% interest rate, the total amount I'm going to pay back, sick, you guys, disgusting. $881,000 in just interest, $531,000. That's if I pay for 30 years. So I just wanted to reiterate how important it is. Okay, if you already say you already have a low interest rate, you're not going to refinance. Refinancing, you start the clock over again unless you shorten your term during the refinance. But the power of extra mortgage payments, I cannot tell you how important that is. You guys, if I just, let's just say I add $300 a month extra to my mortgage payment. Okay, so just $300 extra to my mortgage payment. That's it. Let's calculate this now. So if I add just $300, this is insane. To me, it's insane. If I add just $300 more to my mortgage payment, I save 8 years and 8 months. I save 8 years and 8 months on my mortgage. 8 years, you guys. 8 years by adding $300. That's insane to me. You save, let's see here, total interest. So you save $179,000. That's how bad some of these mortgages are. And the reason is I use the term front loaded and someone freaked out. It's not front loaded. It's not front loaded. It is front loaded. The way it's amortized, the amortization schedule, you pay your interest before you pay your principal. In fact, your last payment on your mortgage is 100% principal. They want to wait to the very end to give you that principal paid out. I'm just saying, let's look at the 10-year now. The 10-year is insane. So much to talk about here, you guys. So yesterday, the 10-year skyrocketed and exploded. We ended, you guys, I'm freaking out because like this is unprecedented. The fluctuations and the volatilities right now is so crazy. So yesterday, and you guys remember I did the live yesterday and we were under 4%. So later on yesterday, the 10-year skyrocketed and ended almost 11 basis points higher. That's crazy. So look at, we're well in the 4% again. we're well in the 4% again. Just wanted to let everyone know that we're 14 basis points into the 4%. Now, let me explain what happened this morning. This morning started out with this 10-year down 2 to 3 basis points. This went up about, I don't know, let me see if I can see it in the chart. I don't know why this chart is updating, but it actually started skyrocketing back up about, I think it was 8:30, around 8:30. And this is an important thing to watch because this tracks mortgage rates. So more than likely, not only did we get a massive skyrocketed upward yesterday, we're also going to get an additional increase in interest rates as far as residential mortgage rates today. So people that are going into the weekend purchasing or locking in rates are not going to have a good time locking rates this weekend. Now, if you want to know why, because I was texting Johnny. Johnny was like, it's just going to go down tomorrow, and it's not down. One of the primary reasons it's not down is PPI. PPI prices picked up in July, so it's higher than expected. Increase fueled by the service sector. Oh my gosh, I wonder if inflation's gone. Oh, it's not gone, but I could have told them that. I mean, just look at the housing market. But let me read this for you guys. Basically, what happened is, so far, PPI came in hotter than expected. The producer price index rose 0.3% in July. The Labor Department said Friday. That's up from a revised flat reading in June, and it in the largest gain since January. Economists polled by Wall Street basically forecasted 0.2. So forecast 0.2 came in at 0.3. The core producer price index, which excludes really important, food and energy prices, and trade services, rose 0.2% in July, down from 0.0% gain in the prior month. Over the past year, headline PPI is running at 0.8% in July, up 0.2% from the prior month. So sorry about that. My picture was in the way right there. So anyways, you guys, it came in hot. Didn't know if you guys knew that. So literally as soon as that came out, almost the second, that 10-year starts shooting back up. And ultimately, here's what it's doing to interest rates. Now, this isn't taking into account today's increase on the 10-year. And again, that's why it's cool to watch the 10-year, because we know that rates are going to go up today. Probably not like a lot, but they're going to go up today. So yesterday they ended, this is crazy. They ended up again, not almost 10 basis points. So 30-year fixed, 9 basis points up yesterday, sitting at 7.14 for the absolute best of credit, right? You got to have a 760 credit score, 25% down payment, and you may be able to get that really low 7.14%. It's not really. First of all, I know what the boomers are going to say, Travis, it's historic, because I had this conversation with my wife's father. He was like, Travis, the interest rates are still so low. They're still so low. They were way higher in my day. And I'm like, I get it. My first rate was 6.7. I get it. But then I was like, hey, what were home prices back then? $60,000? And he's like, yeah. I'm like, well, you forgot that part, right? Like, let's look at unaffordability. Payment to income ratio. Payment to income ratio is as high as it was in the 70s and 80s right now. So anyways, we're talking about price and interest rate, obviously, but look at that, you guys. It is up to 7.14%. So what I'm going to do now is we're going to listen to our first video. Now this first video is kind of interesting. So this first video is basically talking about what happened to the 10-year. And basically, they're trying to figure out, why did the 10-year skyrocket yesterday? Because it skyrocketed yesterday. So let me know what you guys think. But when I listen to this, it really makes me kind of, think that the market is like crazy right now. Like no one knows what's going on right now. So it's crazy, you guys. If you can, let me know that the audio is good. But here's our first video. The second video is going to make you cringe. But here's the first video.
Slipping in this market a little bit. It feels as if, the rally attempts have been unwound. And even some of the intraday declines have been picked up. What do you make of the churn?
We seem to have a pattern over the last several weeks where any rally attempt is being met with sellers and reversing intraday. Clearly, post the 30-year auction at 1 p.m., we saw the long end of the curve, yields begin to spike, equities fall back. So, Mike, people could talk ad nauseum about the fact of you could replace the leadership for mega cap technology and technology, but can you really? Because we haven't done that in the last 10 days, clearly. And it looks to me like the price wants to go down and shake the hand of the moving averages. 50 days down at 44.32. It's about time we touch it.
So the yield pressure, do you feel as if that's mostly about we're recognizing there's a lot of supply out here, we're not imminently going to be tipping into recession, or is there something more going on?
Well, I think there's two dynamics. I think there is the increase in issuance. That's clearly leading to a little bit of nervousness. It's less about the Fitch debt downgrade, but there's also this dynamic. The asset management industry is long duration and wants to get longer duration. Hedge funds, speculators, they're short duration, they're short treasuries. So you have a little bit of this battle going on. It's playing out at a time, a seasonally weak period for equities where there's not much liquidity. So you're going to see a lot of intraday volatility in the bond market.
All right, guys, let me know what you think.
I've been taking Balance of Nature for 25.
I listen to that. It makes me think like the bulls, like the leading bulls, they're like ants. They're just running around everywhere. They don't know what's going on. They're like, yeah, this is good. This is why. Da, 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 da. But maybe it's because the Federal Reserve is doing quantitative tightening. Maybe if we just listen to the Federal Reserve, we won't be surprised by these things. I don't know. Maybe I'm wrong. But let's see real quick. Let me go here. And I found this article. I thought it was interesting. Again, you guys, a lot of people didn't, including myself, did not, even though they did the 30-year Treasury sale yesterday, they did the 10-year, I think, on Wednesday. So again, a lot of people were blindsided by that 10-year skyrocketing yesterday. I mean, it really caught a lot of people off guard. Here's an article that kind of breaks down what's going on. Mortgage rates mysteriously surge back towards long-term highs. Again, this was done like right after the 10-year started skyrocketing. Okay, it may be a bit of a stretch to consider today a surge, as it wasn't much bigger than some of the other increases in the past few weeks, but it was certainly mysterious. When it came to the potential of interest rate volatility, today's main event was the release of the Consumer Price Index for July. This was one of the major monthly economic reports that guide financial markets and the Fed in determining where interest rates should be. If inflation came out higher than expected, rates were likely to rise, but the data actually suggested the opposite. And this is why people were taken off guard, because CPI came out and it was great, it was good, except for shelter. Obviously, shelter was horrible, which is what we're watching. But it came out and the 10-year is supposed to go down, but instead it shot up. Interesting. Despite the friendly inflation report, rates ended up rising somewhat abruptly in the middle of the day, in the afternoon. There are several potential scapegoats being discussed around the bond market campfire, but none of them aligned with the timing of the movement. So, in other words, guys, and this goes on and on, but in other words, they don't know what's going on. There's so much money right now. There's people playing with our stuff. There's people manipulating our numbers. I'm going to tell you guys that right now. Now, here's the thing. Maybe you guys remember we talked about the reverse repo market. The reverse repo market, which is like the 1 month treasury. It's the money that the banks are putting in to get like 5% back from the Federal Reserve or from the government. And essentially the treasury, for a lack of better words, let's just say the treasury wants that money. They want that money to go into, say, longer term maturities, maybe a 2-year, maybe a 6-month. So that money actually started going back up in the opposite direction of where they want it to go. I'll show you guys that right now. So what I also wanted to point out is it just started going down again. So I don't know if that's one of the reasons why the long-term maturities skyrocketed yesterday. I'm pretty sure it's not, but maybe a part of that is because they want this money. And again, it's been going up overall since July 20th. So again, it finally hit, like it broke that, that low peak. So it's going down again. So I don't know. We'll keep our eyes on that. I find it very, very intriguing to watch the money. Because watching the money really tells us just what's going on. There's just so much money in the market. Now we're going to move on to our second video, you guys. The second video, oh my gosh, it's hard to listen to. I mean, this guy, first of all, just make it through the video, but it's going to start super naive. It's really hard to stomach part of this. But listen to what he's saying, okay? And then we're going to go into like the inversion and things like that. If you guys can, just let me know that the audio is okay. I'm going to get this going for you right now.
Takeaways from the data this morning different now than they seemed at first glance?
I don't think the data is really the story. I think the market's come a long way, Kelly. We've had an incredible year in stocks, and I think far superseded even some of the most bullish forecasts.
For sure.
So it's a healthy correction. I think what the Bank of Japan has done, some of the weaker data out of China, there's just a lot of things that I think are sinking in and saying maybe we shouldn't have gone that far, that fast.
You think?
That's kind of
Do you think
my
there's
view.
some hiker's remorse? Or you mean,
No, not at the Fed.
so far that
No.
so fast with the rally?
Yeah,
but
the
hikes
market
were
is just sort of
appropriate.
like
Got
we
it.
kind of got ahead of ourselves,
Yeah.
and I think we're taking a healthy break. I think at the Fed, everybody's pretty happy. I think the Fed's ecstatic about this data. I think they're ecstatic about where they sit. I think they probably, we got one more CPI before the next meeting, assuming that's not a 0.3 or 0.4, they get to sit again. I think they're in great shape going into the end of the year.
Goldman, Steve, says they're done, that there was no September hike, which we've talked about. They say no November hike, that this is kind of it. There's not going to be the need to go again. And I don't know how much of a difference that makes when some people in the market are talking about when the pivot and the first cuts might come early next year. That's their take. This is it.
Yeah, unlike Goldman, I'm a little more humble before the future and the fates. I
I'm
don't
probably wording it more strongly than they
pretend
would.
to know what's going to happen. I think that they're not going to hike in September. I think the data will dictate whether or not they hike in November. I don't think they're quite ready to roll out the aircraft carrier and put on the flight jacket and get up there with the mission accomplished banner in the background. And you can see where the market is trading. I do want to just take a moment, market may be up, market may be down, but it would always pain me to live through wonderful times and not notice it. There's a quote from the Richmond Fed put out a paper today, and I just want to read you the quote. The current cycle is the first time over the entire post-war period the FOMC has made significant progress in lowering inflation without an associated increase in the unemployment rate.
Okay.
So to the extent that David says they're ecstatic, I think they're very happy over there right now.
The movie is not over.
No.
Movie is not
It's
over.
been 1 year
Right,
since they started
right,
hiking.
right.
It's not even been a full
it's
year
been
since
16
the
months.
yield
It's been
curve
16
started.
months.
Since March.
16 months.
Come
What
on,
this
lady.
paper shows is that by now, in previous cycles, you would have the unemployment rate rising, and you're there. And we're going to talk tomorrow, a little tease about
This
why.
doesn't make you nervous at all?
Of course, it makes
The
me
victory.
nervous.
This to me feels like the mission accomplished.
Kelly,
With
the art of the job is to sit here and be nervous, but not show it at all. Of course, I'm nervous. I'm just saying, to this point, it has been an extraordinary run. And if you have it, maybe this is one of those 3-hour Scorsese movies. I don't know. Or maybe it's a normal 2-hour movie and we're kind of at the end of it. Right, exactly.
I mean, there is a lot.
Or I'm going to throw this out there. Maybe it's a dead cat bounce. Like that happens always, like forever. Maybe it's a dead cat bounce. Let's keep going.
Left, and the next chapter is actually being written in the markets.
Right.
Let's look at what is priced into next year. It's 140 basis points of rate cuts between DEES 2023 and DEES 2024. That's the spread between the SOFR rates. 140.
Yeah.
And that's what the market is pricing in. So that's feeding into equity valuations. That's feeding into spreads. I think the market's got a lot more optimism than the Fed. The Fed is far more cautious, far more nervous, far more, as Steve said, this is not wave out the banner time. This is not mission accomplished time. And there's no, we're done, we're great. I don't think they're saying that at all anytime soon. I think they're behind the scenes. They're super happy.
No, and
they're not gonna wave that flag.
Well, I would
Anytime.
imagine.
The FOMC held a secret meeting today, and they raised rates. It's true. What happened today is that rates got more restrictive. The inflation rate came down, and the real funds rate went up today. Obviously, they didn't have a secret meeting. Stop with your Twitter nonsense over there. But here's what happened. And this is the plan the Fed has in place. I guess you could call it a slow boil. And I'll let David address the equity aspect of that. But let's say inflation does continue this trajectory. Guys, I have those two big numbers in the back. I want to show you where we're at on a 3-month average annual basis. And these are very good numbers. We're 3% on the core, 1.9% on the headline. These are great numbers. If they continue like this, and in continued downward trajectory, what's going to happen is the Fed is going to become increasingly restrictive over time. And this will help in this inflation fight. It's like pouring additional water on that fire to make sure that it's out. And the Fed seems to have the market convinced that it will be in this high range for a while. I get, David, the first rate cut built in March or February, or March or April
March,
of next
yeah.
year, where it's a 50% or higher. And so for 7 months, they've got the market, at least at this point, on board with that growing restrictiveness of policy.
Only thing to
All right, let's see what the market's actually pricing in here. Now, so basically, I don't know how you guys felt on that. I mean, interesting points. Someone made some. You guys' comments are out of control. Some of the comments are absolutely to die for, hilarious. I wanted to show you guys. Now, here's the thing. Let me show you tell you my point. Why aren't any of these bulls, even the Federal Reserve, why isn't anyone talking about the yield curve inversion? The fact that literally no one, Federal Reserve, bulls, nobody, including who we just listened to, is talking about the yield curve inversion scares me. That scares me. They're like, look over there, look over there. Don't talk about the yield curve inversion. Don't talk about the historical precedents of caution. Don't talk about the warning signs, the clear indication of incoming recession. Don't look at that. Look at this rally. Look at this dead cat bounce. Isn't it amazing? Isn't the consumer so strong right now, even though we just passed $1 trillion in debt? Who cares? They got $6 trillion more they can charge, right? I'm telling you guys, this is shady. I don't like it. I mean, it scares me when people aren't talking about like the biggest like warning sign ever. It's scary. Let me show you the inversion. Here's the 10 and the 2. Now, it's sitting at 0.73. It actually started or let's just say uninverting. Let me move my camera. I'm so sorry, guys. I just cannot see right behind it. So it was kind of going up fairly quickly. Last time it had this trajectory upward was during the bank runs. So it actually shot up, but look, it crashed back down to now I'm just talking about the depth of inversion now. It's still inverted, by the way. But it did go back up yesterday at 0.73 basis point inversion. It's just really interesting to see the movement here of the depth of the inversion. And remember, you guys, let me max this out for you, just in case you're just now joining. Remember, generally, the inversion is signaling a recession, and generally it reinverts, and then we head into recession. You can see that basically it inverted here, and then reinverted, recession. Same thing with this recession, same thing with this recession, same thing with this recession. But what makes what we're going through now different is the inflation battle, the Federal Reserve's quantitative tightening battling inflation. So I honestly think we're going to go into a recession inverted. I'm now thinking, again, and we can see that when we go back to the 70s and 80s. In the 70s and 80s, we went into recession while we were inverted already. So it is likely, it is a possibility, and I think it's a large probability, to be honest with you, that we don't get the reinversion. We actually are in recession because of the overwhelming inflation. We stay inverted. And we can see through the negative industrial production, which is an indicator that we're actively in recession, is signaling that we're also in recession right now. So I'm not saying we are, because I hate making these guesses, especially when I'm wrong. I hate it. But it's really possible we're starting Q3 of 2023 out at the start of a recession. It's possible. I don't know. You guys also remember I said as long as we have that recession like prior or like right around that home buying seasonality next year, we'll be fine. What I don't want to see happen is we go into recession and then the Federal Reserve cuts rates 300 basis points right before or during home buying season, which is basically what happened this year. Remember what happened this year and this is one reason why equity run up as well. And don't forget this. After the bank runs, the interest rates went down. Interest rates during prime home buying season dropped to the low 6s. Right now we're in like low 7s. It was an interest rate almost not quite, but almost a full percentage point lower when we had such the large equity run up this year. So, we just want to keep our eye on this, guys. That's all I'm really trying to say. Let's look at the 5-year break even. This is something that the Federal Reserve is watching. And really, this is going to signal to the Fed it's time to start to cut rates. This is the market's expectation of where inflation is going to be 5 years from now, okay? So basically they're saying 2.25, and that just went up. So, day over day, it went up again. This is really not what the Federal Reserve wants to do. This is like what, a stagflation type of situation. On one hand, oh my gosh, we are in horrible inflation. And then we're bad, but we're beating inflation. What the heck is going on? All of this data, you guys, is really what I'm trying to say. It's all messed up. This needs to be about under 2. Once this is under 2, more, and I'm not 100% sure, but it's probable that that's when the Federal Reserve will start cutting the rates. Now I want to show you guys this. We're going to go to the CME FedWatch tool, and we're going to see how the market's now reacting after the PPI report. Okay. And let's see, let me refresh this. I already looked right when it came out. Let's see if it's changed now. It's the same. So let me explain to you essentially that the market is not anticipating a second rate hike this year. In fact, it's almost the same. The market is saying it's almost the same probability of a quarter basis point decrease or reduction in January. So they're saying it's almost the same odds. And if you guys see here, September, the market's writing off a quarter basis, any rate hike at all. They're basically saying it's going to stay the same. And now in November, it did change. We did have change in November. This did go up. It's probably went up because the PPI came in hot, right? So now there's a higher likelihood of a rate increase. So they're saying November 32.9. Before PPI came out, I believe that was mid-20s. I think it was around 25%. Take a look at December, you guys. December also went up. So now it's at 30%. So they're saying 1/3 chance now. Again, before PPI, I think this was at more like low 20s. So a lot of movement there. But overall, the market is not fully pricing in a second rate hike, which is really, really interesting. At least it's interesting to me. Now, what I want to do, guys, you may remember me saying new homes leading price declines, specifically if you're in a metro area that's surrounded by new home construction. So that, again, as long as you're surrounded by it, should, seep into or spread to existing homes. Okay. So that's why I'm always looking at new homes. Now, I've also told you, as far as the price declines, which they started about 2 weeks ago. I showed you guys that. I also said that generally it starts with Lennar and it spreads to other people. So I want to show you guys a new development community in my area by accessing my matrix, my local MLS. And I'm going to show you guys that those price cuts have actually started spreading. Now, if you're an agent, a realtor, and you have access to this program, I'm going to show you how to do this because it's so easy. I love the matrix. So I'm going to go to this subdivision, the Highlands. I love the Highlands, you guys. I want to live there. It's just the prices are so expensive. It's such a cool subdivision. I love it. I love it. So we're going to look at the Highlands right now. Okay, there we go. Now, if you only want to look at the new builds, you just put in 2022 to 2023. Now, all I want to see is homes with price decreases. That's it. So you see how I can just really like laser focus this data? I love it, you guys. So I'm going to show you guys price decreases for new homes in the Highlands. Let's take a look at the results because I want to show you guys basically the price cuts are spreading to other builders. I mean, look at all these homes. Let me categorize this by price per square foot. I mean, the price per square foot is just too high. The cheapest one's 163 square foot. Anyways, let's look at some of these houses. I want to show you the price cuts here. So here, this is a hefty price cut right here. This is from Lennar though. So that's a really nice price cut from 315 to 358. Look at to the right of me. I'm going to go to the next one right now. This is only a $10,000 price cut. Let's see the builder. This builder is Perry Home. So it has spread over to Perry Homes. So we have Lennar cutting prices. That's now spread over to Perry Homes. Let's see if I can show you guys one more before I move on. This is also a Lennar price cut. This is a little price cut, only $8,000, but at least it's something. Who's this? This is from Coventry. I didn't know that Coventry was slashing. So Coventry is also cutting. Let's see who else is on here. This is $13,000 price deduction. Who's this? This is Norwalk Homes. So, and there's another one in here that's cutting as well, but Norwalk Homes. But anyways, really what I was trying to show you is it is spreading. And why should you care about that? Well, you should care about that because some people still think that there is no hope. Literally, even people that I love and respect like vital signs. Oh, James, brother, I see you, James. It's been a long time, brother James. Love you, man. What happened to your emails, James? Sorry about that, guys. My point is, chillax a little bit. Things always change. We know that things are overvalued, guys. How many times do I have to show you the equity run up? Like, I know it feels bad. It feels bad to me too, my feelings, but that's why we have data, and I understand it's manipulated. Trust me, I get it. It is manipulated. Now, let me pull up some comments, you guys, and I'm going to get out of here. Appreciate you guys' time. Boom, 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 boom. Let's see. I think I pretty much covered everything. I'm going to go into, basically the 3 future home buyers as well, and what we should be doing on the sidelines, or whether we're actively buying right now. So I'll get into that, but let me pull up. I see you, James. See you, brother. Let me pull up some of the comments that I starred as I was going through this presentation. And let's talk about a little bit of this, starting with Robert. Here's Robert's comment. Life alters plans sometimes. I'm getting 2 total knee replacements, and I will be out of work for more than 6 months. I have saved, but this is going to be a big hit. Robert, brother, I'm sorry you're going through that, man. I wish you nothing but the best. You will be in my prayers. Hang in there, brother. You're not alone. People are struggling. You guys, the reason I'm bringing Robert's comment up is because I just want to remind you that these are things that people don't plan on. So if you're a recent buyer, right, and you have no equity, you have a super high interest rate, or you're thinking about buying right now because you just can't control your emotions, or you just think it's a great time to buy, understand, if anything changes, you could be like dead in the water. If you're living paycheck to paycheck right now, if anything happens to your income, it's game over. And what I mean by game over, you may be able to do a loan mod, you may be able to lower your payment, which would be nice, but your credit worthiness is done. A loan modification is almost like a foreclosure when it comes to your credit rating. So anyways, Robert, thank you for sharing your experience, man. I'm really sorry you're going through that. But you guys, that's a cautionary tale, right? It's the things that we don't plan for that hurts us the most. Now, I have another comment from Dental Coverage here. There is a ton of second homes for sale, each one sitting empty as sellers are living in the past trying to FUMO the last of the dumb money. So it's a harsh comment, you guys. That's a harsh comment, but like, it happens every time. It happens every time. People got to go to the end until it crashes. People got to YOLO. You only live once. Go buy a house. It's crazy. So I don't want to say dumb money, because there are people that are buying that are finding their dream houses and maybe also getting a good deal. So it's just mostly dumb money. At least I think so. And I want to be cautious. I don't want to pick on anyone. Okay, here's a comment from Christina Clark. I am a boomer, and it's way different now. My 85-year-old parent tries to tell me things were worse back in the day. No, I think it's worse now. So let me know if you guys think it's worse. On one hand, it's not worse at all. And on the other hand, it's way worse. So on one hand, it's not worse because of the overwhelming opportunities and the overwhelming ability to educate ourselves and empower ourselves with YouTube. They didn't have that back in the boomer. They didn't have YouTube. I could literally become an expert in many different fields if I go to YouTube University. So we have all this education, we have all this opportunity, and yet I also feel like things are worse, but not because of the opportunity, not because of the knowledge and empowerment, because of the laziness. Because it feels like, I'm gonna talk about my feelings. It feels like now these days there are more irresponsible young adults than have ever been created in history. Maybe you could call that bad parenting, call it whatever you want. It's insane. So I would say maturity and like money management is way worse. And it's probably because people started getting soft and lazy because of too much opportunity. I said it. Hopefully you're not mad at me. I'm not trying to pick on anyone. But the reality is there's so many people that are spoiled. I know what it's like to, with overwhelming unemployment. Do y'all know what it's like? Some of you do, some of you don't. If you went through that last financial collapse and you were caught up in that, I couldn't find a job, you guys. And I was very talented, although I felt defeated at the time. All right, I see the super chat. Thank you. I'm going to get to that super chat. AJ, the unemployment rate is about to go up. We're already seeing it in YouTube comments. That's true. So the thing is, guys, and we did a podcast with Jack at Nobody's Special Finance, and he really dug into those unemployment numbers. And the fact is, month over month, we lost 500,000 over in 1 month, over, and not even counting yellow, we lost over 500,000 jobs full-time. Now that full-time jobs were replaced with part-time jobs. So the labor market is it's a complete joke. In my opinion, it's a complete joke. And I really am so discouraged knowing that our leaders are just doing that. Christy, good morning. I have a lot of homes saved. It's been interesting watching them sit and price reductions. Last year was so different. So she's in a metro area where she sees something similar to what I'm saying, which is price cuts, inventory going up, and better deals and less demand. The problem is, guys, and why I pulled her comment up is it's not going on in every metro area. So obviously, in order to understand if it's going on in your metro area, you should be doing your homework and your research. What I show you in my lives, market analysis, right? Things like that. Midwest, appreciate the $10, brother. You didn't have to do that. And I really appreciate your support, man. Kind of forced to buy now due to person I'm renting from deciding to sell. What's the best place for non-agent to access MLS data? So there's one reason why you want MLS data. Sold property. That's it. That's literally the only reason. Like, the advantage of having MLS is so you can access what has sold. So if you don't, like, the problem is you can't really do the market analysis, Midwest, without the comparable data, the comps or the sold property. So I would say one of the best services you can use just to access live data is probably just Zillow and Redfin, because they have access to MLS data. Again, though, like, I can't make special reports like I do on MLS, but I will say, brother, one of the best ways, in my opinion, to start interviewing and selecting realtors is by calling realtors and say, hey, and don't lie to people. I'm not saying lie to you. You want to be honest to your professionals. You always are honest, always. You want to call them up like, hey, I'm interested in purchasing. I'm, interviewing realtors. Say I'm qualified. One of the things I want to do to find a great realtor is I want to see if you can provide me data. So can you provide me a market analysis for 2020 as far as price per square foot in the subdivision? And then the same thing with rental houses. So that's what you should do. But I also want to say this, Midwest, because I noticed something in your comment as well. Okay, forced. I'm kind of forced. You're not kind of forced. Who's forcing you? So that's the thing, man. That's what I really am trying to say. I think that what's happening, Midwest, is you let that like narrative of like you have to own a house in order to be a man, American, adult, or you're a woman, I don't know. But like you have to buy a house or you're not living the American dream. BS. You got time. Most people have time to not only buy a house, but you have time to better your purchasing power. Like if your credit score is not 780, get it up. If you don't have 6 months of reserves saved, keep saving. If you have any consumer debt, pay it off. We have time. So I don't think you are forced to sell, man. I really don't. I don't think you're forced to sell. Try not to put that. Again, I don't know you, man. I don't know your goals, but just based on this little, what little I do know about your comment, I would just say, tread lightly. But if you must buy, get what I would be doing, because I can't give personalized financial advice. I would be, again, getting pre-qualified with a lender. I would know what my payment would be, and I would know what my out-of-pocket expense would be. Okay. So before I'm even walking into the market, I know my payment, my out-of-pocket expense, and I know that I'm qualified. Do you know what I mean, brother? So probably Zillow, but again, oh my gosh, I got a new member. I didn't know that we can do that. Welcome, Philip. Hope you like my pictures, man. Philip, where's your comment, man? Thank you so much, brother. You didn't have to do that. I really appreciate the support. You guys have no idea how much y'all support means to me, you guys. I have a full-time job. Oh, okay. Here's a question. Okay, I have this question right here. His landlord is selling. He can rent somewhere else, though. That's the thing, Dental. So to the last comment, he can rent somewhere else. I understand his landlord's selling, so go find out another place to rent that's cheaper, right? Maybe for 6 months, maybe for a year. You have that option is the point I was trying to make. Sorry for leaving that out. Thank you for holding me accountable, Dental. Okay, so from Philip, Travis, I have a question. How does a 2% origination fee sound on a $240,000 FHA 30-year loan? Philip, I need to know more. I need to know if that 2% origination is going to buying your rate down. And I also need to know your FICO score. So here's the thing. I have to answer this very, very carefully. Okay. Here's the thing. What you guys are going to see in this market of volatility is rates cost money. it's very hard to find what's called par interest rates, which means you qualify for a rate and it doesn't cost you money. The reason why we're seeing interest rates cost so much money right now, and I see what you said right there, Philip, right there, 700 FICO score. The reason why interest rates cost money right now is the wild swings in rates. So the market never has enough time to rebalance for the drastic changes in rates. So in order for the lenders to protect themselves, they keep charges or percentage called discount points on the loan. So, a 5% interest rate can cost you 3%. Now, here's the thing. Boom, boom, boom. Now, if it's just an origination fill up, like if it's only origination, yeah, that's a lot. Okay. I'm going to say right now, like for example, the company that I work for, AMCAP Home Loans, the origination fee it's a total fee. I think it's $1,400. So even if your loan's $420,000, origination fee, I think it's either it depends on the loan, but let's say the maximum 1,600. I think it's 1,600 maximum. So your origination fee, 2% at 420,000. That's an origination fee of $8,400, brother. So I'm gonna say, heck yeah, that's way too much. Unless again, first of all, I don't know what your CD. I can't believe closing disclosure or LE loan estimate looks like, but I would imagine if the money is not going to buying your rate down, then that's not a good deal, man. From the outside looking in, I don't know nothing about the deal. I don't want to stop on anyone's toes. You may have some LLPAs, loan level price adjustments that you don't know about. But again, that's usually on the discount, not the origination side. So I would question it. I would question it if it was me. All right, you guys, anything else? So a couple things, guys. Now, remember, I want to start doing a financial, I want to start reviewing people's financials and do a live video. So if you guys are interested, email me if you want me to take a look at your, and we'll cross out social security numbers, account numbers, cross out your personal info. But if you guys are interested in me doing a live video and going over your credit report, your bank statements, your paycheck stuff, so I can see how you're spending your money, right? And kind of want me to put myself in your shoes and maybe talk about what I would be doing if I was you, email me. My email is in the description. On the subject line, put interview for financials. And I'm trying to do a better job at staying on top of my emails. But remember, you guys, I have a full-time job. I'm not a full-time YouTuber. So all of this love I get from you guys, I mean it. It really does keep me going. I am so burnt out, you guys, right now. And I'm telling myself, just keep working hard, Travis. Keep working hard. Make as much money as possible. It's worth it. But I am burnt out. So if anyone else out there is feeling outworked and burnt out, definitely have a lot of empathy for you. I'm going through that myself right now. Anyways, you guys, I appreciate you so much. You guys have a great day. Stay safe out there. And I want no one going out to the bar, no one going out drinking. I want you guys to go home, go download Credit Karma, and make a budget and a goal for yourself unless you already have it. Now, other than that, guys, have a great evening. And if you're out there investing in real estate, you guys already know I wish you luck, and I hope you win.